Folks, are you ready to learn about taxes and investments and the different types of accounts and how they're taxed? Well, I've got a little bit of a lesson for you, so let's get going. Here I am at my whiteboard. We've got 3 buckets. These buckets represent the 3 different ways money can be taxed in investment accounts. So bucket number 1, we're gonna go with, let's go with pre-tax. Come on, handwriting, don't fail me now. Pre-tax. This would be like your 401k or your IRA. 401k, IRA. The money you put into this account is not taxed yet. So it's going to be taxed when you take it out. That is what that means. So when you put in money into a 401k, it is reducing your taxable income dollar for dollar by the amount that you put in to that account. The next tax bucket we got here is tax-free. One of my favorites, but they're all my favorites when it makes sense for you. So tax-free would be Roth IRA or a 401k Roth, and these are cool because basically you get money from your paycheck and you're like, well, I already paid taxes. My paycheck, withheld all that money for taxes. We all love that, how your salary is $100,000, but it feels like you're getting 50, that feeling. So you take that money that you get into your bank account and you put it into a Roth IRA. You've already paid tax, so Uncle Sam can never touch this money again. When you put that in there and you invest it, it grows and grows and grows. And when you take it out, you've already paid off Mr. Uncle Sam, so you get that money tax-free. The last bucket is taxable. This is like your Robinhood account, your E-Trade account, your Charles Schwab account. It's not an IRA, it's not a tax-advantaged vehicle, but because it's not a tax-advantaged vehicle, doesn't mean that there's not tax advantages. So you invest in here, let's say you invest in Apple, Boeing, and whatever. And so they give you dividends. A dividend is the money that the company, the profits that it gives to its shareholders. The money you get as dividends will be taxed. And if you were to sell your Apple and you had a gain in it, you'll have to pay capital gains tax. So you have to pay dividend tax on dividends. If you had a bond and you got interest, you have to pay interest on tax on the interest. And that's basically how that works. For dividends, qualified dividends, there's a dividend tax rate. You don't have to pay ordinary income tax. And for the dividends, whether or not you pay ordinary income tax rate or the capital gains tax rate depends on whether the dividend is qualified or unqualified. That's probably too much for this lesson, but there you go. Pre-tax, tax-free, taxable. On this, they all have their advantages. And the general rule of thumb would be to have a little bit of pre-tax, a little bit of tax-free, and a little bit of taxable. In fact, no, the goal is to have a lot of all 3 of them, right? So when you have a lot of all 3, you have what we would call tax diversification. Just like you have a diversified portfolio full of all different kinds of assets and different asset classes, like you have some tech companies and you have some utility companies, yada, yada, yada. So that's tax diversification, having all 3. And then whatever the percentage is, 40% tax-free, 60, okay, that's 100, so we're giving nothing there. 40% tax-free, 20% taxable, whatever, 20%, you get what I'm trying to say. This would be your tax allocation. Just like you have an asset allocation, meaning what are the different asset classes you're invested in, you have a tax allocation, which is the different buckets you have and what percentage is each bucket. That's your lesson. Thank you so much for being a part of the lesson.